The federal tax rules regarding C corporations ensure that income is subject to taxes twice. There's tax at the corporate level. Taxes are then levied again when making distributions to shareholders. If you're a C corporation wondering about your chances of having to undergo a corporate tax audit, keep watching for interesting information and insights. What's in review? If you're wondering what happens in an IRS audit, the main purpose of the audit is to make sure the business is paying the proper amount of taxes. The size of the business and whether it files its own taxes or it uses an outside account has no bearing on the decision to conduct an audit. The IRS audit follows a set of specific procedures. When you're facing an IRS audit, you need experienced tax attorneys who specialize in the audit process. They'll make sure the audit is properly handled and will get things resolved quickly. Your attorney will keep track of deadlines to make sure nothing slips through the cracks. Selling stock. When C corporations are issuing stock, they need to make sure the transactions are legitimate and not a way to hide what would otherwise be taxable income. The IRS will review stock sales to determine if the selling price of shares was at fair market value. If the sale was at a discount that was substantial, this indicates a purpose other than raising capital. Employing shareholders. A small corporation may have shareholders and their family members managing the company. The IRS realizes this provides the opportunity to hide non-deductible payments into deductible compensation. If an employee appears to be receiving excess compensation, the auditors will determine whether the salary is a way of reducing the tax rate on corporate earnings. It's also sometimes used as a way to make non-deductible political contributions. Form 1120 Schedule M1. Corporations tend to keep their books and records according to generally accepted accounting principles, GAAP. This means there's usually a difference between the net income on the books and the amount shown for tax purposes. Schedule M1 reconciles book income or loss with the income or loss calculated under tax laws. This makes it possible to report an incorrect amount of corporate tax. The IRS will review the details of reconciliation. This ensures the business uses proper rules when making adjusting entries. Avoiding an audit. When it comes to large corporations, the IRS watches for specific activities that may trigger an audit. To avoid standing out under an IRS microscope, avoid things such as filing forms 1096, 1099 late or claiming 100% business use on a vehicle when the driver has no personal vehicle. Don't try to mark down exorbitantly high expenses in areas of entertainment, meals, or automobiles, or not paying or receiving interest on loans to officers, as it gives the appearance of moving money to hide it. The list goes on, and it's good due diligence to learn about these red flags, because every corporation wants to lower the amount on their books to lower their taxes. If steps taken are too drastic or aggressive, they increase the chances of an IRS audit. Even if you take all appropriate steps to avoid an audit, you may find yourself holding an IRS audit notice. Your first call needs to be to qualified tax attorneys who can answer your questions quickly. Our knowledgeable attorneys will walk you through the audit process, making sure a resolution is reached in a timely fashion and all deadlines are met. We can help you avoid levies and keep payments and penalties from spiraling out of control. Contact us today to schedule an appointment so we can answer questions and discuss your tax-related case.